The AI market moved first. Crypto followed. Pause on that for a moment. This is not coincidence. This is correlation. And right now, on PolymarketTrade's analytics dashboard, the heatmap is lit. An AI regulation contract has moved 14% in the last 4 hours. The traders who saw it coming were not reading a newswire first. They were watching which markets cluster together, which categories share capital flows, and which price movements echo across the board. In this video, we are going to learn exactly how to read that signal, starting from the very beginning, assuming you have never opened a prediction market in your life. Before we open the heatmap, we need a foundation. A prediction market is a contract. It resolves to $1 if a stated outcome occurs, say, the Federal Reserve cuts rates at the September FOMC meeting, and to 0 if it does not. The price of that contract at any given moment, expressed as a number between 0 and 1, is the aggregated crowd forecast. If the contract is trading at 62 cents, the implied probability is 62%. It is not a recommendation. It is a live, continuously updated consensus built by anyone willing to take a position. Now, the question becomes, what happens when you have dozens of these contracts, all responding to the same macro environment, the same Fed signals, the same geopolitical headlines, the same inflation prints? Open the Correlation Analytics panel and the first thing you see is a grid, a matrix of every tracked market category laid against every other. The color in each cell tells you how those two categories have moved relative to each other over the rolling 30-day window. Deep red means strong positive correlation. When one moves up, the other tends to move up. Deep blue is the inverse. One rises while the other falls. Gray or near white cells indicate noise, not signal. The intensity of the color scales with the coefficient. A dark red cell reading 0.8 is a very different statement from a pale pink cell at 0.2. As a beginner, the rule of thumb is straightforward: focus on the deep cells. That is where the analytical structure lives. Switch to the network graph view and the data becomes spatial. Each node represents a single prediction market. The size of the node reflects the volume of open contracts. Larger nodes are more liquid, more actively traded. The lines connecting nodes appear only when the correlation coefficient between two markets crosses a meaningful threshold. The algorithm filters out low-confidence relationships automatically. The tighter the cluster of nodes, the more those markets share a common driver, a central bank decision, a geopolitical flashpoint, a technology regulatory cycle. When you see a dense cluster, say, 5 or 6 AI and semiconductor markets bound tightly together, you are looking at a category that is pricing the same underlying risk from several different angles. That structural exposure is precisely what the graph is designed to surface. The clustering algorithm draws on 3 distinct data inputs, and understanding all 3 is what separates a superficial reading from a properly grounded one. First, shared event tags. Markets tagged with Fed or FOMC or inflation are placed in proximity because they are explicitly about the same macro driver. Second, capital flow patterns. When significant new contract volume opens across multiple markets on the same afternoon, that co-movement is recorded and weighted into the model. Third, and most importantly, rolling 30-day price correlation. This is the statistical foundation, calculated continuously, updated as prices shift. The algorithm synthesizes all 3 signals into the graph you see. It is not just price history. It is structural taxonomy and capital context layered on top. Now let us apply this. Suppose you hold yes contracts on a market asking whether a major AI regulation bill will pass by the third quarter of this year. The price is sitting at 62%, a relatively strong consensus, but one that is acutely sensitive to Washington headlines. Any development around semiconductor export controls, BRICS technology policy, or NATO defense technology standards could move that price sharply and quickly. The question a careful analyst asks is, are there other markets on this platform that have historically moved with this one? And if so, could taking a position in one of those correlated markets provide a partial offset if the AI contract moves against you? That is the logic we are about to put to work. Pull up the heat map and locate the RAW for AI regulation markets. Run your eye along to the column for crypto infrastructure. The cell reads 0.67 deep red, a strong positive correlation. Now switch to the network graph. The two markets are visibly clustered, sharing a direct edge, with a handful of semiconductor sanctions markets sitting between them as connective tissue. The analytical interpretation is this: historically, when macro pressure on AI governance rises, whether from Washington, Brussels, or Beijing, crypto infrastructure markets have faced analogous headwinds. Similar regulatory narratives, similar capital outflows from risk assets, similar investor sentiment around technology policy. The correlation is not accidental. It reflects a shared policy environment, and that shared environment is precisely what makes it structurally useful. Here is the mechanics. You are long yes on AI regulation. The correlated instrument is a crypto infrastructure contract, something like will major crypto exchanges face new federal licensing requirements by year-end. Open the hedging example panel on PolymarketTrade. You can see the suggested offset position displayed, a NO contract on the crypto market, sized proportionally to the coefficient. Because the correlation is 0.67 and not 1.0, you do not fully neutralize the exposure, you reduce it. If the macro environment shifts against AI governance, perhaps a geopolitical development softens the legislative timeline, the AI contract dips. But the crypto NO contract, facing the same softened regulatory environment, is likely to appreciate. The two positions work in partial opposition, smoothing your overall exposure to the shared macro driver. Let us distill this into a repeatable three-step process you can apply to any position. Step 1. Open the correlation heat map and focus on your target market's row. Look for cells with a coefficient above 0.6, that is your threshold for a relationship strong enough to merit attention. Step 2. Validate in the network graph. If the two markets appear in the same cluster sharing a direct edge, the structural confirmation is there. If they sit in separate clusters with no visible connection, the heatmap figure may reflect a temporary co-movement rather than a durable shared driver. Treat it with more caution. Step 3. Size the offset proportionally. A coefficient of 0.67 suggests your position covers roughly 2/3 of the correlated risk, not all of it. Apply that ratio. This is the kind of disciplined, analytical position management that macro investors and central bank watchers apply in traditional asset markets every day, now available at the level of individual prediction contracts. You have now seen how the correlation heatmap works, how the network graph exposes the structural relationships between markets, and how a straightforward three-step process lets you use those insights to build a partial offset on any position you hold. The correlation analytics tool is live on PolymarketTrade right now. The heatmap and network graph are fully accessible without an account. In the next video in this series, we go deeper into the cluster detail panel, how to read intra-category signals, and how to identify which markets within a cluster are the most liquid anchors for a correlated position. Subscribe so you do not miss it. Leave a comment below with the market category you would most like to see analyzed: Fed rate path, ceasefire probability, or something else entirely. This has been PolymarketTrade tutorial. Good day.